CCI International didn't just, like, beat Q4 consensus. I mean, they completely shattered it.
Yeah. Adjusted EPS came in at 8.91 cents, which blew past the $7.32 estimates by, over 21%.
Okay.
And revenue hit $2.71 billion, up almost 18% year over year. But the real shocker was their fiscal 2027 guidance.
Right, the guidance. They totally crushed expectations there.
Exactly. We're talking a revenue midpoint of $10.75 billion.
Right.
And adjusted EPS guided to between $32.96 and $33.86. The stock surged over 21% the very next day.
Wow. So our mission for you today is to really dive into the earnings reports and transcripts to uncover exactly how, a legacy government contractor printed these kinds of numbers and what it all means for your portfolio.
Yeah, and the profitability surge is what really drives this whole story. I mean, Q4 EBITDA margins hit 13.0%, which is up 150 basis points.
Which is a huge jump for them.
It really is. And it's driven by this stark segment shift. So their fiscal 2026 technology segment revenue grew like almost 17% to $5.58 billion. Meanwhile, their traditional expertise segment grew just 3.5%.
So it's basically like watching an old school, hourly government consulting firm transform into a high-margin sauce company right before your eyes.
Yeah, essentially. They are totally shifting their model.
But wait, with fixed-price contracts now nearing 35% of their mix, aren't they taking on massive cost overrun risks? Because, in defense contracting, fixed price is a notorious trap if you are stuck doing open-ended development.
Well, normally, yes, you'd be totally right to worry about that. But management's commentary addressed exactly how they're dodging that bullet.
Oh, okay, how so?
They're increasingly selling software-defined, commercial-ready technology. So when you deploy an existing product, fixed-price contracting actually protects your margins. You aren't billing for unpredictable research hours.
Right, you're just handing over a finished solution, so they aren't just putting bodies in seats anymore, right?
Exactly. They're selling off-the-shelf defense tech.
The transcripts actually highlighted a $500 million domestic Shield win for their Skyvalor counter-drone system, alongside some highly classified counterspace hardware.
Yeah, and this tech transition is directly feeding their massive $32 billion total backlog. And to move faster, CCI is aggressively leveraging OTA or other transaction authority contracts.
Which lets them bypass the sluggish federal procurement process.
Yeah, exactly, the notoriously slow procurement loop. And the value of those OTA awards more than doubled this year.
Wow. But, moving that aggressively to buy and deploy new tech usually comes with a heavy price tag. And looking at the headlines, there's a weird disconnect. If they're crushing it on the adjusted side, why did GAAP EPS actually drop 1.3% down to $7.05?
Right, so that gap drop is heavily driven by the interest expenses from their $2.6 billion acquisition of RK.
Ah, okay, that makes sense. The debt load changes the picture.
Yeah, that massive purchase was literally the cost of acquiring the high-margin space and defense tech we just talked about. But taking on that debt pushed their pro forma net leverage up to 3.7 times trailing EBITDA.
That is a pretty high multiple for them to carry.
It is. Between that heavy leverage, a pending $42 million legal judgment, and the constant threat of, macro budget delays in Washington, there's very little room for error.
Yeah, carrying 3.7 times leverage in a sector where Congress can just freeze your budget overnight is a really heavy load. So what's their timeline for cleaning up that balance sheet?
Well, management's stated goal is to bring that leverage back down to the low threes by June of 2027. And to pull that off, they're heavily relying on their massive projected free cash flow.
Right, which they estimate will be, at least $900 million next year?
Yeah, exactly. At least $900 million.
Which leaves you with a final, provocative thought to mull over for your own portfolio. Can CACI's aggressive transition into a high-margin tech company continue to outpace the heavy debt they took on to acquire those capabilities, especially if federal defense spending suddenly tightens?
It's definitely the key question going forward.
Absolutely. We'll be sure to follow the show for your daily earnings coverage, and we will catch you on the next deep dive.